Earnings per share is one of the most widely used ratios by both analysts and stockholders. If you look at the name earnings per share, it kind of tells you how to do the calculation. You take your earnings or your profit for each and every share that there is for the common stockholders. Earnings per share is such an important ratio that it's actually reported in the financial statements. In order to understand earnings per share, we'll also have to get an understanding of the capital structure of the company. Is it a simple capital structure or is it a complex capital structure? A simple capital structure means that there's no convertible stocks. There's no stock warrants. There's no stock options. There's nothing out there that can be converted to become more additional common stock. In other words, all the common stock that's being reported is the only place that common stock can come from unless additional common stock is issued by the board. When we have a simple capital structure, we can calculate a basic earnings per share. To do a basic earnings per share, we just take the profit of the company from the income statement. We call it the net income and subtract from it the preferred dividends. We subtract the preferred dividends because, as we learned earlier, preferred dividends are promised to the preferred stockholders. And so those dividends are never going to go to the common stockholders. So that's why we subtract them out of the profit. What's left over, then we divide by the weighted average number of common stock outstanding. In other words, the number of shares we have. Let's look at a quick example of the most straightforward calculation of a basic earnings per share. So in this example, our company has net income of $1 million. They have preferred dividends of $20,000, and then the common stock that they have outstanding is 10,000 shares, and these have been outstanding all year. There's never been a change to the number of shares. So in our first example, we're going to see a company that has profit or net income of $500,000 for the year. They have preferred dividends of $20,000, so those are the dividends that are going to the preferred shareholders. And then we have common stock, and this common stock has been outstanding the entire year. It's never changed. It's been 100,000 shares from January 1st all the way until December 31st. So the earnings per share is $4.80. Now the reason that we want to focus on this weighted average number of common stock outstanding is because that bottom number could have a significant impact on the earnings per share that we have. Let's say management reduces the outstanding stock at the very end of the year, let's say middle of December. They reduce the shares from 100,000 shares to 50,000 shares. Look at the impact it has on the earnings per share. It jumps from 480 to 960. Since oftentimes managers are being evaluated on the earnings per share, we needed to have a way to show this was occurring. And that is why, instead of just using how many shares are outstanding at the end of the year, we use this weighted average number of common stock outstanding. The weighted average just means that we base the number of shares on how long or how much of the year it's been outstanding. Let's look at a calculation. Okay, so let's say we begin the year with 160,000 shares of stock, but then on September 1st, the board of directors issues an additional 40,000 shares of stock. So to do a weighted average, we just want to give a weight to how long each of those shares were outstanding during the year. The 160,000 shares were outstanding from the beginning of the year all the way until the end. So they have 12 out of 12 months. So just do 12 divided by 12, which is 1, times 160,000 shares equals 160,000 shares. The 40,000 shares, however, are only outstanding from September 1st until December 31st. So we take 4 months, September through December, 4 months, so it's 4/12 times the 40,000 shares, and that gives us 13,333 shares. So the weighted average common stock is 173,333 shares. We've just given shares weight based on the amount of time that they were outstanding. Now when we put that in our formula, we're able to calculate the earnings per share, and we're taking into consideration how long the shares were outstanding. Now, an earnings per share is calculated differently if a company has a complex capital structure. A complex capital structure means that there are some convertible stocks or bonds out there, or there might be some options or warrants. A convertible stock or bond can change from a preferred stock or bond into a common stock. So what that means is that it's going to give us more shares of stocks out there that could affect the earnings per share ratio. Now, keep in mind that these convertible stocks and bonds haven't been converted yet. They're just potential. They have a potential impact on the earnings per share. Options and warrants give the holder the right to buy stock at a certain price. They don't require the holder to buy the stock at a certain price, but they give the owner the right to buy the stock at a certain price. So if you have an option to buy a stock at $10 a share, that means that you can, if you want, buy the stock at $10 a share. Again, when these options and warrants are out there, that means that there's the potential to affect the number of shares, which could impact the ratio for the earnings per share. So there may be some call options, some employee stock options. A warrant is usually tied on to or connected with a bond or a preferred stock, and it gives the holder the right to get shares of common stock at a certain price. So they're all very related as far as options and warrants as their effect that they would have on the earnings per share. All of these things have potential dilution. So the way the diluted earnings per share works is we're kind of looking at a worst case scenario. What is going to happen that's going to hurt our earnings per share? We want to report that. So we'll take the basic number that we calculated before and we make an adjustment to the income based on any impact that converting preferred stock or bonds into common stock would have. And then we look at the basic number for the weighted average common stock, and then we add to it any shares that would occur if we made the conversion. So we're doing a what-if scenario here. We're saying, well, what would happen if we converted these? What would that effect have on our income, and what would the effect be to the number of shares? So let's look at this example with ABC Corporation. Their profit for the year is $177,500. They began the year with 100,000 shares of common stock, and they had 2,500 shares of preferred stock. On October 1st, they sold an additional 10,000 shares of common stock. They paid dividends to the common stockholders in December. So first of all, let's look at the weighted average number of shares computed. So first of all, let's look at the preferred stock. It's an 8% preferred stock, $100 par value, times 2,500 shares. So that means that we're going to have a $20,000 preferred dividend every year. So when we do the basic earnings per share calculation, we're going to take the profit that was provided in the information of $177,500, and we're going to take out the preferred dividends. Again, there's no point in including the preferred dividends for the common stockholders because those dividends go to the preferred stockholders before the common stockholders get any kind of access to the dividends. Then we're going to divide by the weighted average number of shares. So since the 100,000 shares were available for the entire year, so they had 100,000 shares outstanding from January 1st until December 31st, and then that's 12 out of 12 months. Then on October 1st, they sold an additional 10,000 shares. So from October till the end of December is 3 months. 3 divided by 12 times 10,000 shares gives us a weighted average number of shares of 2,500. So you add those two up and we get 102,500. So in this case, our basic earnings per share would be $1.54 per share. Let's add some information to this problem. What if each share of preferred stock is convertible into 8 shares of common stock? So you can take 1 share of preferred stock and turn it into 8 shares of common. That would increase the number of common stock, and that number of common stock increasing would bring the earnings per share down. Bringing the earnings per share down can potentially harm investors and change the way analysts look at the stock. And so by finding a diluted earnings per share, we're able to report the potential harmful impact that this conversion could have on the earnings per share number. So let's first look at the conversion. So if 1 share preferred stock can be converted to 8 shares of common, then 8 shares times 2,500 preferred stock equals 20,000 potential new shares of common stock. That's how many new shares of common stock would be out there if the preferred stock were converted into 8 shares of common stock. So then let's look at what this would do to our basic earnings per share number. We're going to call this the diluted earnings per share. We're going to take the net income But we're going to make an adjustment, right? Because before we subtracted the preferred dividends. But think about it. If the preferred stock is converted into common stock, then there's not going to be any preferred dividends. So we're going to change the $20,000 preferred dividends to 0. And then we're going to divide by the weighted average number of common stock, which we got earlier, as 102,500 shares. Now we're going to take that number and add to it the converted shares of common stock if that were to occur. So when we make these adjustments, we get a diluted earnings per share of $1.34 per share. As you recall, the basic earnings per share was $1.54. It's been reduced down to $1.34. So the diluted earnings per share shows potential negative impact that we would have by making the conversion. Now that we've kind of got an understanding of stock options, of common stock, of preferred stock, let's talk about share-based compensation. A lot of executives, they don't get paid just on a base salary. A lot of times they get paid with stock options. Why do they do that? Why do they use stock options? Well, first of all, we have goal congruency. So if stock does well, the options are going to be very valuable to the executive. So if we give the CFO, for example, stock options as part of his or her compensation package, and then the company does well, then the CFO does well. So that's called goal congruency, because what's good for the stockholders is also what's good for the CFO, for the managers. Another reason is there's some companies out there that don't have a lot of cash. Maybe they're a startup company and they don't have a lot of cash yet to pay for a really talented manager or management team. So they use stock options. Or if it's a high growth company. High growth companies are taking all of their profits in cash and pouring it into future growth. And so they don't have the cash to give to the managers as a compensation. Instead, they might use stock options. There's a discussion with the accountants, with the management of corporations, whether or not stock options should be expensed. Some say yes. They say yes. Why? Because most executive pay includes some type of option. They say yes because the stock options should hit the profits, in their opinion, because it is part of compensation. If you're using this as compensation and it's not reducing profits, it's not an expense of some sort, it just doesn't make sense to them. And there are costs associated with having stock options. You have to get them created, and there's legal fees and stuff of that nature. A lot of people say that they shouldn't be expensed because, first of all, there's no cash outlay for an option, meaning you're given the CFO or the employee the right to purchase the stock at a certain price, but you're not requiring them to buy the stock at a certain price. There's no cash that's being given to the executive right away. There's also no standard to measure the option expense. If we were going to expense the option, what would we use for the number? There's no real easy answer for that. They also say no because they want to keep using options, and it's a really good way to attract management talent. Managers can see how they can get very wealthy through options. And a lot of people like using options to attract managers because it gets the managers to not take the easy road. They'll take more risks. They'll act more like an entrepreneur. They'll look for ways of innovation. That's the kind of thing that a stock option can lead to, whereas if you're just paying the employee a salary, they don't necessarily take the extra risks. They're not as worried about the company doing well as if they're getting an option. So what does GAAP tell us? How should we account for stock options and compensation expense? The rules of GAAP say that we should require firms to record as a compensation expense on the grant date value of the option. Doesn't specify the pricing model to use, though. This makes it very confusing for organizations to apply GAAP. Finally, we're going to talk about the treasury stock. Treasury stock means that a company repurchases its own stock off the stock market. If you were ABC company, you go out to the stock market and you buy shares of ABC. If you're Tesla, you buy shares of Tesla. If you're IBM, you buy shares of IBM. So you're buying your own stock off the market. That's what a treasury stock is. Why is it that they do that? Why would they buy their own stock off the market? Well, first of all, they might need the stock in order to cover stock options. So if a CFO has an option to buy 1,000 shares of stock, then the company has to have the 1,000 shares of stock to give to them. They can either get them off the market, or they might have to reissue them, and that can sometimes be a lot more complicated because you have to go through the board of directors. It could be that the stock is a good deal. Maybe the stock, they find it to be undervalued, and they feel that buying their own stock is a good investment in themselves. They can also buy stock to block hostile takeovers. So if a company wants to take you over, they can do that by buying your stock off the market. So beat them to the punch. Buy your own stock first. When you start buying your own stock, it tends to make the price go up, and you might not be as attractive to the hostile takeover. Another reason is it improves the earnings per share. So if managers are getting evaluated based on earnings per share, they might start to buy stock off the market to make that bottom number go down. By making the bottom number go down, they can make the earnings per share go up.